Okay, it's great to be here today, everybody. Today we're going to talk about power trend spread trading, and this is one of our favorite strategies over the years. It's performed well in all types of markets, and uh, it's performing well in the current market, and we'll show you some real-time results for the option spread trades. So today we're going to look at trading debit spreads. And when you initiate a debit spread, the spread has built-in profit potential from when the trade is initiated. And debit spreads can profit if the underlying stock is up, down, or flat at option expiration. And we'll show you some examples of that. And it's possible to achieve a 25% to 40% return if the underlying stock is flat or down as much as 10% at option expiration. So whenever you can profit when the stock is up or down, this will increase your percentage of winning trades. Now, the maximum risk for a debit spread trade is the cost of the spread. And one of the neat things about debit spreads is they allow you to trade higher price stocks like Apple, Google, MasterCard, or Amazon for as little as $300, which is a lot lower cost than if you were to purchase an in-the-money call option for these high-price stocks. So this is a way to play the higher price stocks at a low cost. And a portfolio of debit spreads can be traded in a $5,000 account. And our brokerage statements that I'll display towards the end there show that we have over $1.8 million in actual profits trading debit spreads. Now, we initiate bullish debit spreads when the underlying stock or ETF is on a power trend buy signal, and we initiate bearish debit spreads when the underlying stock or ETF is on a power trend sell signal. A stock is on a power trend buy signal if the 1-month price of the stock is trading above the 10-month simple moving average, which indicates that the stock is in a price uptrend. So this black line right here is the monthly price chart, the monthly price for MasterCard, and the blue line right here is the 10-month simple moving average for MasterCard. So this is the 1-month price and the 10-month simple moving average. So we can see back in July, the 1-month price of MasterCard crossed above the 10-month simple moving average, and at that point MasterCard was on a power trend buy signal. And as long as the stock price remains above the 10-month simple moving average, then MasterCard is on a power trend buy signal, and we should consider initiating bullish debit spreads for MasterCard. Here's an example of a sell signal. This is for Macy's, and we're displaying the 1-month price, which is the red and black line right here. The 10-month simple moving average is this blue line. So we can see Macy's stock price cross below the 10-month simple moving average right here. And at that point, Macy's was on a power trend sell signal. And as long as the stock remains below the 10-month simple moving average, the stock is still on a sell signal. So bearish debit spreads using put options should be considered. And we profited during the 2008 bear market by initiating bearish debit spreads using put options. So we were able to profit during that severe bear market. So to initiate a bullish debit spread, you buy to open an in-the-money call option, and you sell to open a related call option with a higher strike price with the same expiration date. So it's pretty simple to initiate. You buy to open an in-the-money call and sell to open a call with a higher strike price. Now, the call purchase and the call sale can be done simultaneously, or you can purchase a call and then sell a call at a later date to leg into the spread. So we use both types of entries. We'll initiate simultaneous entries, and we will also purchase call options using our call option system. And if we have a profit in that call option at a later date, we'll leg into a debit spread. So we use both types of entries. So the call option that you purchase will profit if the price of the underlying stock increases, and the call option that you sell will profit if the price of the underlying stock decreases, and it provides downside protection if the stock price decreases. And as I mentioned, your risk is limited to the cost of the spread. So we normally initiate spreads with 1 to 3 months until expiration, and debit spreads can cost as little as $200 to $300 using the leg-in method of entry, and normally they cost between $700 and $1,200 using the simultaneous method of entry. And you can trade a portfolio of debit spreads in a $5,000 trading account, and the full profit potential of the spread is realized if the underlying stock closes at or above the strike price of the call option that was sold. So if you sell an in-the-money call, the price of the underlying stock does not have to increase to realize the full profit potential of the spread trade. So the stock could be flat and you could still realize the full profit potential. And most of the time it can realize a 25 to 40% return if the stock is flat at option expiration, and also profit if the stock is down as much as 10% when we use the simultaneous entry method. So the spreads can profit if the stock is up, down, or flat, and this gives us a big edge over directional trading, which requires the underlying stock to move up in price to be profitable. So obviously you're going to have a higher percentage of winning trades with spread trades compared to directional option trades if you can profit when the underlying stock is up, down, or flat. And this higher percentage of winning trades can give you that discipline needed to become a successful trader. And as I mentioned, directional option trades, call option trades require the underlying stock to increase in price to profit. And when you're trading directional trades, volatile markets can result in getting stopped out of a directional option trade, and volatile markets can result in 100% loss for your directional option trade. And remember, if you purchase an at-the-money or an out-of-the-money call option and the underlying stock closes flat or down at option expiration, then you'll realize 100% loss on the trade. So we try to avoid those 100% losers by trading spreads. And debit spreads have built-in downside protection that can allow you to hold on to the spread during volatile market moves without being stopped out. And we'll show you examples of that. So let's look at a couple bullish debit spreads using the simultaneous entry method of purchasing the call and selling the call simultaneously. And these examples we'll look at expire in 1.5 to 2.5 months. We're going to look first at the SOXL, the SOXL, and it's the symbol for the leveraged semiconductor ETF. And SOXL was on a power trend buy signal with the stock price trading above the 10-month simple moving average. So our brokerage confirmation shows that we bought the SOXL February 140 call at at 35.95, and we sold, let's see here. Okay, and this was a simultaneous entry. I was looking for the first leg of the spread, but this is a simultaneous entry. So we simultaneously bought to open the Soxal February 140 call at 35.90, and we simultaneously sold the February 150 call at 29 points. So bought to open the 140 call at 35.90, sold to open a 150 call at 29.00. So this was what they call a simultaneous entry with the entry into the long and the short call simultaneously. So Soxal was trading at 166.72 when we took this snapshot, and we bought the 140 call and we sold the 150 call. So that was an in-the-money spread as the strike prices were less than the current stock price. So when you buy to open the 140 call at 35.90 and you sell to open the February 150 call at 29 points, you get a credit of 29 points when you sell to open a call. So the net cost of the spread was 6.90 or $690. And that would be debited from your brokerage account. And hence the name debit spreads. So again, we bought to open the 140 call 35.90, sold to open the 150 call at 29. We get a credit for that sale, so the spread winds up costing us $690. So due to option pricing characteristics, debit spreads have a pricing quirk that gives you built-in profit potential. So we saw where the cost of the spread is 6.90. This is a 10-point spread. The 140, 150 is a 10-point spread. The cost is 690. So if we subtract the 690 cost from the spread of 10, we come up with a profit potential of $310. So we had built-in profit potential from the minute we entered this trade. So again, the cost was 690, the spread is 10, so that gives us a profit potential of $310 that's built in from when we initiate the spread. Now, in the money spreads give us more downside protection and a higher probability that the trade's going to be profitable. And in the money spreads can profit if the underlying stock is down as much as 10% at option expiration. So when we leg in, when we enter a spread trade using the simultaneous method, we like to do in the money spreads because they have more downside protection and a higher probability that the trade will be profitable. So we created a series of calculators that will calculate the profit potential of a spread before we initiate the spread. And the calculators will calculate the profit potential for an option trade based on the price change in the underlying stock at option expiration. And these are pretty neat because we can look at our calculator before we take the trade, and then we know what the profit potential is. So we use the calculator to calculate the profit potential for this Soxal spread trade before we took the trade. And the calculator will calculate the profit potential for a trade assuming various price changes in the underlying stock at option expiration. And in this example, we used a 10% increase in the underlying ETF to a 10% decline in price. So we inputted the current stock price of 166.72. We bought the 140 strike call at 35.90. We sold the 150 strike at 29 points. And then we're assuming in this top row right here, the various price changes in Soxhol from the 10% increase to 183.39 to a 10% decrease to 150.05. So based on that, the calculator will calculate the profit potential for this trade. And the second row from the bottom, which is this row right here, gives you the profit potential for the trade. In this example, it has a $310 profit potential, and the bottom row lists the percent return potential for the trade. So we can see if the Soxhol is flat at option expiration at 166.72, the spread will realize a $310 profit and a return of 44.9% before commissions. And we can also see that if the Soxhol increases in price at all, we'll realize a $310 profit and a 44.9% return. So if the ETF is flat or up at all, we're going to realize a 44.9% return. Now let's look at the downside protection this spread provides, and we can see that if the spread is down as much as 10% to 150.05, we're still going to realize the $310 profit potential and a 44.9% return. So again, if SOXL is up at all, we'll have a $310 profit, 44% return. Same return if it's flat, and if it's down as much as 10%. So profiting 44% when your stock is flat or down 10% gives you a much higher probability of success as a trader. And don't forget, if you purchase a call option and the underlying stock closes at or below the strike price of the call, you're going to realize 100% loss on the trade. So we saw in this spread trade, if SOXL is flat, we'll have a 44% return. But if you purchase a call option on SOXL and the ETF closes at or below the strike price of the call, then you'll realize 100% loss on the trade. So we like to mitigate that loss potential when you're trading options by trading spreads. Let's look at another example. This is for EDC, and EDC is the symbol for the leveraged emerging markets ETF. And our brokerage confirmation shows that we bought the EDC February 107 calls at 21.55 and sold the 115 calls at 15.65. And EDC was trading at 126 when this trade was initiated, and we bought the 107 call and sold the 115. They're below the current ETF price, so this was an in-the-money spread. The net cost for this spread, if we subtract the credit we got for the sale of the 115 call of 15.65 from the cost of the 107 call, we come up with a net debit of $590 for this spread trade. And if we take a look at the call option calculator, we can see if EDC is flat at option expiration at 126.03, we'll realize a $210 profit and a 35% return. If EDC is down 10%, we'll realize a $53 profit and an 8.9% return on this trade. So again, due to the option pricing characteristics, this EDC debit spread had a built-in profit potential of $210 when we initiated the trade. Now, what I did is I took a snapshot today of one of my brokerage accounts, and I looked at my profit results over the last 2 months using the simultaneous entry method of for debit spread. So in these examples, I bought and sold the call simultaneously. So these are a listing of the trades. In this column, we have the option spread. The first one here is for Apple. I bought the January 260 call and sold the January 265 call. And this column lists the open date, the close date. So this one was opened on November 20th, and I purchased the 260 call at 1083, sold the 265 call at 813. So this had a cost of 2.70 or $270. Closed it out December 24th, so I was in the trade a little bit longer than a month, and with the closed out the 260 call with a profit of $52,772 and closed out the short call at $45,505. So this had about a $7,200 profit for this trade if you net out the long and short call. So this was about a $7,000 profit for the first trade here. Again, this lists the spread that I took, the opening date, the opening price, closing date, closing price, and the net profit or loss. So I had a total profit of $51,776. And what I did is I downloaded those trades onto an Excel spreadsheet and was able to calculate the profit, the actual closed out profit for each spread. So in the first example, where I bought the Apple January 260, sold the 265, we had roughly a $7,200 profit, and the return on this spread was 76%. AMD had a 74% return. I had a FAS spread that had a 58% return. Cure, which is the leveraged healthcare ETF, 59% return. So the only losing trade was the KLAC, and I closed that out at a 38% loss. All the other trades were winning trades. And again, the total profits for these trades was $51,776, and the average return was 58%. So they were all winning trades except for that one losing trade. Average return 58% over the last 2 months, and these were all initiated using the simultaneous entry method for debit spreads. So we have an option trading service, and we send out email alerts to members with instructions whenever we have a new option trade recommendation, or if we're going to close out an existing trade or roll it over. And we make trade recommendations for option debit spreads, and we use both the simultaneous method of entry and also the leg-in method. And we maintain a portfolio of our open trades, and those prices are updated daily so that members can track the profit performance of all the option trades. And we also maintain a closed trade record whenever we close out a trade, so that we account for all the trades that are made in the option advisory service. And I took a snapshot today of the open trades, and you can see in this column we list the spread, our entry price, quantity, last price, dollar profit, and percent return. So as of today, we have open trade profits and debit spread portfolio of $216,000 and an average return of 180%. So if you want to get updates on how our option advisory service is doing, and you can see we trade a variety of strategies: option purchase, small account option purchase, covered calls, option spreads, and market neutral spreads. So if you want to get an update, we update the open trade profits, and if you want to see how these various strategies are doing, you just log on to weeklyoptionalert.com, or you can call Brad toll free at this number to get an update on how the various portfolios are doing. And you can also click on weeklyoptionalert.com, you can also click the trade results page. You don't need a login to click through to that page, and then it will give you the current open trade profits for these various option strategies.